Hello and welcome to Learning with Mike. Did you recently become an investor? Did you buy hot stocks like AMC and GameStop last year? Well, this is the video for you. Today I'll be explaining the difference between long-term and short-term capital gains taxes and how you can pay less tax. Whenever you sell an asset for more than you bought it for, this will result in a capital gain. How much tax you pay on that gain actually depends on how long you held the asset before selling it. Short-term capital gains apply to the gains when you sell stocks that you've held less than a year and are taxed as ordinary income according to your tax bracket. Displayed on the screen now are the short-term capital gains rates for 2021 and 2022. For example, the average American makes $68,700 and would be taxed according to the chart at 22%. Feel free to pause the video so you could determine what is your tax rate and come back once you're done. Long-term capital gains, on the other hand, apply to profits that you made for stocks that you held longer than a year and are usually taxed more favorably. Displayed on the screen now are the long-term capital gain rates for 2021 and 2022. That's right, you're not seeing this wrong. If your income falls within a certain tax range, you could actually be paying zero taxes on your capital gains if you held the stock more than a year. That means you could be taking 100% of your profits home. Like before, feel free to pause the video, find your long-term capital gain rate, and then come back to the video once you're done. Now that you understand short-term and long-term capital gains, let's apply to some examples using AMC. Since none of us have paper hands here, let's use an imaginary friend as an example. For this example, let's assume the following. Our friend is single. He has an average salary of $69,000. He invested $1,000 into AMC a year ago in February at the dip around $6, which gave him a total of 167 shares. Now on scenario 1, let's assume that your friend saw that AMC kept rising and rising, and he sold at the peak around June at $70. How much taxes does he owe then? First, let's calculate how much gains he made. He sold his 167 shares at $70 each for a total of $11,690. Subtracting his initial investment of $1,000, that leaves him with a gain of $10,690. Since our friend bought the stock in February and sold it in June, that means he held it for less than a year, which means that short-term capital gains would apply. In this scenario, his salary is $69,000 and he made gains from selling AMC of $10,690 for a total income of $79,690. Looking at the chart, we can determine that his tax rate for 2021 is 22%. Applying the 22% tax to his $10,690 AMC gains, that leaves him with $8,338.2 that he can keep, and he will owe a total of $2,351.8 in taxes come April. This is really important. You have to remember to save a portion of the gains so you could pay taxes later. Many new investors forget to save that money and reinvest all their gains. This leaves them vulnerable come April when they have to pay a large amount in capital gains. Let's take the same assumptions that we took from scenario 1, but this time rather than selling in June at the high, he waited a whole year and is currently still holding like a champ. Suddenly, sometime this year, AMC starts to rally again and hits that 70 mark, and our friend finally paper hands once more and he sells at $70. How much taxes does he owe now? From our previous calculations, we know that when our friend sells his stock at $70, he will make gains of $10,690, which will bump his income to a total of $79,690. Looking at our long-term capital gain rate chart, we see that he would fall under the 15% bracket. Applying the 15% tax to his 10,690 AMC gains, that would leave him with $9,086.5 that he could keep, and he would owe a total of $1,603.5 taxes come April. By simply holding over a year, our friend could have made $748 more by leveraging long-term capital gains rather than short-term capital gains. At this point, I wanted to remind everyone that I am not a financial advisor, and this is not financial advice. This is for learning and entertainment purposes only. A couple of final reminders. Taxes are normally due on April 15th, but this year they will be due on April 18th. You can also get an extension all the way to October 15th. Just be careful when you're filing for your extension, because if you actually owe any money still, you have to pay that by the April 18th deadline. Otherwise, penalties and interest could accrue. If you found this video helpful and you'd like to learn how to build wealth from the ground up, whether it's through your career, real estate, investments, or business, please like, subscribe, hit the bell, and I'll see you on the next one.